Welcome, everyone, to Optimizing Current Income for Retirement Success, a retirement seminar presented by VM Pensions Management Limited in association with the Private Sector Organization of Jamaica, the PSOJ. I'm Conroy Rose, CEO of VM Pensions Management Limited, and it gives me absolute pleasure to welcome you to this webinar. I will also be guiding you throughout these proceedings. At VM Pensions Management Limited, helping Jamaicans to prepare for their retirement years is very, very important to us. Providing right information that will empower you to make right decisions that allow you to thrive in your retirement years is what drives us. Special welcome to our representative from the PSOJ, Ms. Greta Boog. To our presenters, Cornelia Harper Peck of the Financial Services Commission and Mr. W. St. Elmo White of Actman International Limited, and our very own Julian Mazuka of VM Pensions Management Limited. You will hear more about them later. A special welcome to you for taking the time to join us. This webinar is very, very important to VM Pensions. And currently we have over 1,200 of the PSOJ. Greta Boog is a solution-focused leadership consultant and a certified corporate governance trainer who currently serves as the interim CEO of the PSOJ. In 2001, Greta Boog was appointed as the first female CEO of the combined PSOJ, the Jamaica Association, Exporters Association, the Jamaica Bankers Association, and the Consolidated Business Association Secretariat. Her professional experience spans in the financial industry, non-profit education, and the distribution and manufacturing sector. Greta's public service is extensive and includes serving as a board member of the JEA, the Jamaica Manufacturers Association, the Toll Authority of Jamaica, RTNT, Urban Development Corporation, and the National Council of Education. Greta is currently the chairman of the PSOJ's Corporate Governance Committee. Ladies and gentlemen, here is Greta Boog with opening remarks on behalf of our partner, the PSOJ.
Thank you very much, Mr. Chair. Ladies and gentlemen, distinguished guests, I'm sure that you're all delighted and excited to be here, and so are we at the PSOJ. At the PSOJ, we continue to underline the importance of employing sound financial practices, whether you're working in a large, small, or even a medium-sized enterprise, or even if you are self-employed. The value of investing in your financial future is of paramount importance, whatever size business you have. So we are therefore humbled to continue our partnership with one of our valued members, Victoria Mutual Pension Management Limited, to champion that critical message, and more importantly, following through with its implementation by more Jamaicans of investing and investing for the long term. As an organization, we're led by the mantra, and especially over the past 2 years, our mantra has been focused on moving from advocacy to action, which we will see this initiative as being a part of our mantra. Because this particular seminar will touch the lives of many, many Jamaicans. We salute the Victoria Mutual team for the strong track record your company has built in providing pension services, including investment management, administration, and consultancy. So this year's theme, optimizing current income for retirement success, is especially appropriate as we all experience an unprecedented period of economic uncertainty due to the COVID-19 pandemic. This financial volatility has really underscored the importance of each of us practicing fiscal prudence and investing in our future through retirement planning. Everyone, whether you're salaried or you're self-employed, should know it is their responsibility. It's your responsibility. It's my responsibility. It's our responsibility to ensure that we are able to maintain a quality of life that we can enjoy when we get into those later years. So, ladies and gentlemen, as with many things, over the course of a few months, companies and organizations have had to adapt and evolve. And as the kind word we use, many have had to pivot in order to continue providing the exceptional value that our clients so need. So it is with this understanding that the private sector organization of Jamaica, we're really pleased and extremely delighted to continue with our partnership of 13 years with Victoria Mutual Pension Management Limited to host this seminar. And we've really gotten such positive feedback from participants over the period. So we applaud the Victoria Mutual team for being diligent in providing timely and impactful information through this annual seminar. And we know that the participants this evening will also get new and exciting information to help to guide them through these unprecedented times. Because friends, we have to be ready for our retirement. It's an important part of our life. It's a life that we look for in the future, the life that we want to enjoy. And how we enjoy that is by planning and preparing. And that's what Victoria Mutual Investment does best. So, ladies and gentlemen, enjoy. You will learn a lot, take it back, implement it. And I know the team has a great time planned for you this evening. Thanks very much. And we look forward to partnering with you again next year for this seminar. Thank you.
Thank you, Greta. And the chart of not just being on the advocacy side, we're committed in providing that kind of retirement planning support to our fellow Jamaicans. And very interestingly, that the employed population is contributing to the pension plan. And that is why I asked the question earlier. Are you concerned about life after retirement? And I asked the question earlier, and I will continue to ask the question. Are you currently contributing to a pension? Are you currently contributing to a pension? And we are committed at VM Pensions. And I said, to give that kind of action that will support you. So thanks again, Greta, for the partnership, and we appreciate it. And now it's time for our first speaker. With over 15 years of experience in pension administration, Cornelia Harper Peck was appointed as Senior Director, Pensions at the Financial Services Commission, FSC, in 2018. She oversees the execution of the FSC's mandate to regulate and supervise the pensions industry. The FSC is charged with the protection of pension plan beneficiaries, as well as supporting a healthy and stable pension industry in Jamaica. Prior to her tenure with the FSC, Cornelia held the post of Senior Manager, Pension Administration at Proven Fund Managers Limited and Pension Manager at First Global Financial Services Limited, a former member of Grace Kennedy Group. She's dedicated to her family and in her spare time enjoys quality family time, playing karaoke and traveling throughout Jamaica and beyond. Who better to speak to us about local regulatory framework? Ladies and gentlemen, here is Cornelia Harper speaking on the local pension regulatory framework.
Thank you for having me. On behalf of the entire Financial Services Commission, we're glad to have had this opportunity that we can share with you and provide for greater public education in the pensions industry. Can we start the presentation? Again, thank you. Today, we're going to cover areas in relation to promoting security, industry statistics, member rights, and of course, we will touch on how you go about lodging a complaint and how it will be handled by the Financial Services Commission. The FSC's mandate is to provide for a healthy, growing, and sound pensions industry. We monitor performance and conduct investigations and examinations where there are complaints or heightened risk. We screen and register trustees and licensed administrators and investment managers, as well as ensure adequate disclosures are in place. We want to ensure the right people are serving you. For protecting your investment, every single pension fund, be it a scheme or a superannuation fund, has to have in place an investment policy. And this is very important because this is the document that guides how the trustees and investment managers go about investing your money. The FSC will review these policies and we ensure that they are prudent and in keeping with the objectives and risk profile of the scheme. There are many investment limits in place, and I'm just going to touch on a few just to give you an idea of how we go about protecting you. We have a 10% concentration limit, and that limit essentially speaks to whether or not you can invest or the limit that you can invest in one particular entity. That way, you limit the exposure you have to any particular entity so that if there should be an issue with that entity, it should not jeopardize the entire fund. We have a 10% related party investment limit, as well as 30% limit in the interest of any company that a pension fund can invest in, save and except where they invest in a company that is for the purpose of acquiring real estate. There's also a 5% private equity and debt limit for investment. It is noted that sometimes private equity and debt can attract a higher level of risk, and as such, that risk is managed through this 5% limit. There is also a 10% limit in leases, and 5% non-income earning property limit as well. And this is to ensure that your money is busy being invested to earn an income for you when you retire. When it comes to loans, we want to ensure that monies aren't lent out willy-nilly, right? We want to ensure that when monies are lent out from the fund, it is a proper investment, it is properly secure, and to that end, we ensure and legislate that all loans must be secured. In fact, we go a step further. We say not only should your loan be secured, but the collateral that is used for the loan, the value of it should actually exceed the loan amount. Because if you have to sell that collateral, you want to ensure that even if you have to sell it below market value, you are still able to cover the value of the loan. We want to touch on a little industry statistics, and of course, we would be remiss for not mentioning the impact of COVID on the market. Currently, there are approximately 134,000 people invested in private pension plans, which is the equivalent of roughly 10.62% of the labor force, which is currently 1.2 million. In relation to approved retirement schemes, total assets returns was roughly 12.9%, 13% on average, and this would have seen ARS funds ranging from between 2.56% and 25.86%. But we have to note that this is on the entire pool of investments, and as such, we have to be cognizant that sometimes within an approved retirement scheme, they have many sub-pools of investments. So you may have your money market fund, you may have your equity fund, you may have your fixed income fund, you may have a real estate fund. And for all of these funds, they have their own individual rates of return, which may be higher or lower than the entire pool of assets return. Now, in terms of the impact for COVID, in terms of membership, the impact has not been very significant. In December, we had roughly 60,000 members, and that jumped to 65,321 in March of 2020. And this would have been before we would have seen the impacts of employment related to COVID. Since then, as at June, there's been some fall off, but it has been a very small fall off in the number of persons that are members of approved retirement schemes. In relation to the asset side, we had a total of 50 billion invested as at December 2019. And we recall that there was some significant fall off in asset prices in March, and that would have been reflected in the values of the total assets available in approved retirement schemes. We saw a 7.3% drop in asset value to $46 billion. But nonetheless, we're resilient people and we rebounded. And the market is now, for ARS, the total assets is even higher than December, which is great news. We saw an 11.1% increase by June of 2020. Now let's talk about your rights, because you have to be properly informed so you can best protect yourself. How do you go about choosing the right ARS? There are currently 13 approved retirement schemes from which you may choose. When you're choosing your ARS, you want to make sure that you do your research. You want to ask proper information, get good quality, sound information so you can make your best choice. You want to ask about minimum contributions, and if they have them, can you afford it? You want to find out what fees are charged. This is very important to make sure you're getting value for your money. All right? You want to find out what are the circumstances under which you may have to pay these fees. Now, in these situations, sometimes you might find that there is a fee if you want to terminate your membership in the fund and transfer it to another approved retirement scheme or a superannuation fund. You need to check and find out these things, right? In addition to that, from time to time, as we mentioned before, you have different subpools of investments, and you may want to check, if I were to switch from one pool to another, is there a charge? Do I get a certain number of switches before I have to pay a charge? You want to see what are the implications. You also want to see what are the investment options that are offered to you. Are these risky investments? Conservative? Is there a balanced portfolio? If you're not in a position where you're off pay enough with the investment market that you're able to make the right decision for yourself, What type of default options do they have? Do they have a fund option that you can invest in that is relatively conservative while still taking on enough risk to earn you a suitable retirement fund? You want to have these kind of discussions with the investment advisor that is guiding you. You also want to see how accessible is information. If at the start of the relationship you find that you're not actually getting as much information as you would like, then this is a huge red flag, right? A huge red flag. So you want to pay attention to things like this. Information should be readily available. Do you have online portals that you can access? When you ask for the various information that we're going to get into in terms of your information folder, your handbook, so on, are these information being readily presented to you? And of course, finally, you want to get referrals. When you open a bank account or an investment account, you have to give a referral to substantiate that people do believe that you are a quality customer. Why should you not ask for referrals from your friends, families, co-workers in relation to the ARSs that they are involved in to determine whether or not it is right for you? After all, it is your money. You should be making sure that you're well covered. Now, to support members in making the right decision, there's a lot of information disclosure that the FSC tries to ensure is available to members. And not only do we make sure that this is available to members, we also review them to ensure that the quality is of a certain standard, right? Now, each member is entitled to a handbook, information folder, and an annual report free of cost. You may request the information folder as a prospective member for information to determine if an ARS is right for you. The information folder provides you information about the fees and charges that the fund has. It provides you with description of investments, earnings by the fund, as well as risk description related to any pool or the overall fund itself. It will also provide you with the last 5 years investment return. Now, while past return is not necessarily an indication of future return, at least it gives you some indication of how well the fund manager has managed investments in the past. You are also entitled to your member's handbook. And in general, this is the source that you go to for the layman's outline of what is in your trust deed and rules, your benefits, your rights, your obligations. It will also provide you with information on complaints resolution procedures. It will also provide you with information, very importantly, on how to go about claiming your benefits. You have the annual report, which by indication by the name, you can get it annually. And this will be available on request. But I will say there are some fund managers that send it out automatically to their membership. And this is an important thing because the annual report provides you with very key and important information about the fund and its performance. It provides you with key information about the trustees, the training that they have had, any decisions the trustees have made. It provides you information on the last actuarial valuation report, which will show recommendations put forward by the actuary on how the fund is being managed. It will show you information on financial statements, investment holdings, actual versus targeted returns, so you can see what exactly the trustees are trying to achieve and whether or not they have been able to achieve it via the investment managers. It also provides you with up-to-date contact information for trustees and their advisors. You will get information on the auditor, if there is an auditor for the fund, as well as for the actuary of the fund. Benefit statements are another means by which you can get quite a bit of information. And this must also be provided to you annually free of cost within 4 months of the end of the year of the scheme. And it is also provided to deferred members on request. The member statement must be provided on change of status. So if you have retired, you should get a member statement outlining your benefit and how that benefit is being treated. If you're terminated as a member, you've transferred out your money to another approved retirement scheme or to a superannuation fund, then you should also get a statement that explains exactly what your benefits are at the termination date and how your benefit would be treated. Now, the benefit statements include certain information that is critical. First and foremost, it contains the details of contributions you have made and the investment pools in which you are invested. I know for a lot of people, you open up your statement and you look to see how much money you have, and that is good enough for you. You close the statement once you're satisfied with that and you move on. But I will say that's not good enough. Your statement also contains your personal information, including your name, date of birth, sex, and your contact information. And it's important that you ensure that this information is correct. Would you believe that your sex can actually determine your retirement benefit, or rather have an impact on it? You have to ensure that this information is correct on your statement. And if it is incorrect, you advise your administrator or your trustees. You want to ensure the value of investments that is reported at statement date is in keeping with the expected returns that are being desired. You want to ensure that what is reported is correct. And most importantly, for a lot of persons, your retirement benefit does seem kind of like a bit of mystery, right? You contribute, but you're not quite sure what you're going to get on retirement date. Are you going to get a replacement of your salary? Are you going to get more than your salary? Are you going to get less than your salary? What would you have earned? Now, to help you with this, what you would look at on the statement is the projections. The projections will tell you what your benefit is likely to be at retirement, given your current contributions, possible future contributions, expected rate of earnings, and you will also see an outline of the assumptions that are used in determining what your expected retirement benefit will be. And this is really useful. When you look at this information, one of the big questions you need to ask yourself is, am I saving enough? Do the projections that I have, is that going to be enough to take care of me and accommodate the lifestyle I want to live? Should I be contributing more? Should I be investing in the approved retirement scheme more aggressively to earn a better rate of return? These are questions you need to ask yourself, and very importantly, also your investment advisor. Now, another thing that you need to take a look at on your statement is the details of beneficiaries, the trustees you've appointed, contact information, and share of assets. You know, it's extremely important that you pay attention to this. Is your spouse no longer your spouse? Then maybe you need to update your beneficiaries. Did you have your sister as your beneficiary, but you now have a child? Maybe you need to be updating your beneficiaries. Is the trustee that you had for your child to collect their benefit on their behalf no longer the person you want to do this? If that's the case, you need to update the beneficiaries listing, okay? There are other information that's available as well. You can get at a reasonable cost the trust deed and rules and any amendments thereof. You could get a copy of it. You can also get copies of registration certificates of the scheme and trustees. You can get a copy of the policies and procedure manuals for the scheme as well. Now, lodging a complaint. If all we have done so far hasn't gotten you to the point of satisfaction and you realize there's an issue that you're uncomfortable with, or you're not seeing where your investment manager, administrator, trustees are delivering like they should, then of course you can lodge a complaint. And the first source through which you'd want to lodge that complaint with is, of course, through your trustees or your administrator or investment manager. Now, in this case, we ask you to ensure that you do that in writing. It's very important that you give the entity the opportunity to address the issues directly. And just as a reminder, the members' handbook actually has the process in place for which a complaint should be handled, for how a complaint should be handled, and how you should get a response. What's the framework in place? It is highly recommended that you put your complaint and any discussions in writing and record the names of everyone with whom you would have dealt with regarding this matter. The company should provide, or the trustees should provide, their response to you in writing. Now, if you have found that the resolution you have gotten from the trustees or the company is not to your satisfaction, then you can always make a complaint in writing to the FSC. We will ask you to provide the name of the entities involved or persons. We will ask you to provide the details of the complaint, copies of all correspondence and documents related to the complaint, your full name, all of your direct contact details, because we need to be able to get in touch with you. And of course, this information must be given in writing. We will in fact provide you with a form to fill out the complaint. Complaints must be submitted to the complaints coordinator at the Financial Services Commission at 39 to 43 Barbados Avenue, Kingston 5. The FSC will acknowledge your complaint within 5 working days, and your complaint will be handled in the strictest of confidence. Complaints are investigated by a dedicated team who requests information from all relevant sources. When the investigation is completed, we will write to you outlining our findings and any redress that is available. Again, I would like to thank you for this opportunity, and I would have hoped that I would have given you some amount of information that would have made you feel that much more secure in investing in one of the approved retirement schemes offered. Thank you.
For that comprehensive presentation, what you have shared with our viewers, that we are operating in a very tightly regulated industry, and this demonstrates to them that their funds are safe and secure. And what you also shared was how important it is for you to do a research on any company that you're going to be doing any form of business with. You need to find out how long the company has been around. You have to find out how the company generally treat their members. Is this a Jamaican-owned company? Is this company secure and safe? Is this company going to be here for me for the long run? And these are very important questions that you need to be answered when you're searching for a retirement planning partner. And most importantly, you need to look at the fees. Are there any hidden fees? So these are some important questions that you really need to get answers to when you're checking for and searching for a retirement planning partner. So thank you so much, Cornelia, for that comprehensive presentation. And I guess our viewers now have a better understanding how tightly regulated is the industry. So we will have a special question and answer segment at the end of all the presentations. So we're going to ask you to note your questions, and you can share them in the chat as we will address them at the appropriate time. And if you are just joining us for the first time, this is our 2020 retirement seminar being held by VM Pensions Management Limited in association with the PSOJ. And I'm Conroy Rose, CEO of VM Pensions Management Limited. We will now have our second presentation, and I'm just going to tell you a little about our next presenter. Our next presenter comes to us from Actman International Limited, an organization which provides actuarial, consulting, and training services in the field of retirement planning. W. St. Elmo White is the founder and chief marketing officer of Actman. He also served as a director with NEM Insurance Company, Edward Gale and Company, the Jamaica Unit Trust Services Limited, and the Jamaica Mutual Pension Funds Limited. St. Elmo is a passionate about pensions sector. He believes that every worker, employee should have a pension at retirement, and strongly believes that with some changes in legislation, the pension sector could help to significantly transform Jamaican economy. He has written numerous short papers on pensions and the importance thereof, and is currently writing a second book to be entitled A Handbook of Pension Planning. Ladies and gentlemen, we are here in for a treat, as St. Elmo is a well sought after motivational speaker, presenting on the topic, the simple path to a happy retirement. Here is W. St. Elmo White.
Thank you very much, Mr. Chairman. Good afternoon, ladies and gentlemen. I must confess that the document from which you read is not the most up-to-date of them all. Nonetheless, there's some truth. There was at time truth in everything that was said, but a little bit out of date. But we will move on. I have interpreted my topic as to present a short treatise in personal financial planning, because what we're really talking about here is not just approved pension plans, because you need more than that in retirement. So I've interpreted it a little bit more widely. So I will give you how I will do it. The time is very short, and I'm a long-winded man, but nonetheless, we will see what we can do in 15 minutes. So I will talk under the headings of planning, how to assess investment instruments, and to give some of the more popular investment instruments that people could invest in, and some closing remarks. Now, planning. Again, as I said, the time is short. So human beings have the ability to plan, to look ahead and think and make plans. So you can set objectives. That's the first thing. So when you're planning, you're going to set some objectives. Then you're going to determine some action plans. These you will review and adjust as you go along. You're going to look at, you're talking about retirement. And I would say the most basic instrument to look at is a pension plan. Now, I'm not going to go much into pension plans because somebody is going to come and do it. But I would say the most basic instrument is pension plan. And in your planning, you need to set a target of the sort of monies you would want to have in retirement. And the best way to do this is as a percentage of your salary at retirement. For example, under the pension law, subject to certain conditions, I can't go into everything, you can get a maximum of 75% of your final salary, that's a salary at retirement, as a pension. And of course, the law also allows it to keep its real value by allowing the pension to be increased to the full extent of the CPI. So that's what the pension law says. Now, if you're planning for retirement, it means that having maximized what you will do with the pension plan, you want to look at further income. So you have to come up with your own replacement ratio. The pension says 75% of your final salary. I, for one, would decide that, well, if government says 75%, I want 150%. But it's for you to decide how much you want. And then, based on what your pension is giving you, then you're going to be saving for the rest, right? Now, I'd say one thing about saving and investment. One of the most important elements in saving and investment is time. A lot of people, especially in Jamaica, always think they have time. Oh man, me young. No, I have 20 years, 30 years. Well, time is so very important, and that's one thing you cannot catch up with, right? It will catch up with you, but you cannot catch up with it. Therefore, all of these things should be started very, very early. As a matter of fact, in planning for retirement, to have your happy retirement, you should start to save from the first day you start to work. Sound hard, sound harsh, sound impossible, but that really is the ideal situation. That is what you should be looking at. Now, how do you get to the target that you set? For example, as I said, if I said I want 150% of my final salary, as my income during retirement. And I'm assuming that my pension plan is so good that I will get 75% from a pension scheme. So I need now to save and invest for the rest. Now, I believe the most important instrument for every average, everyday human being like myself is a budget. Now, a lot of us don't like to hear about budgets. As a matter of fact, one of the first things you hear people say, but I don't have no money. So what am I going to budget? But I would think, as a mathematician, I would say the smaller amount of money you have is the greater the importance of the budget. When you look at all these big institutions that earn 10, 15 billion a year in profits, if their budgets are not done on time, the whole accounting and budgeting department get fired. And they can afford it. So clearly, it must be that the man who has the least money is the man to whom a budget is more important. So budgeting is really the financial side of planning. But budgeting is so important because the budget helps you to insist on all sources of your income and to write them down. The budget forces you to insist on all items of expense and to write them down. And I will tell you that in my estimation, the most important item of expense, and the first one, should be the amount of money you intend to invest every month to reach your financial goals. Some people put it for last, so it never make it. I would put it for first and adjust everything else, because that is the sort of discipline and commitment you need in order to do these investments. So, what a budget also does is force you to set priorities. I mean, you could get up one morning and decide, boy, I want 10 pair of shoes. But if you budget one, is one you're going to buy. If you don't budget, you go buy the 10 pair, because you're just doing things. Budget forces you to set priorities. Budget forces you to do the optimal allocation of scarce resources. Sorry. In other words, you're not going to take 10 million to buy one car and you need a house and you already have a car. That is if you budget. If you don't budget, you might just decide, boy, I need 2 cars, right? And forget that you don't have a house, right? So these are some of the things you really have to do. And this budget is very important. Another thing about budget, once you get into it, you try to beat your budget. And that's the most enjoyable part of budgeting. In other words, you budgeted to spend 10,000 for the month and you come in with 9. Who get the extra one? You get all the surplus. And what can you do with it? Invest it, not consume it, right? That is why budgeting is so important and so good. It forces you to do certain things. And then you get into it and you like to do those things. But if you never budget, you never feel that feeling. So budgeting is extremely important. And again, a lot of people say, but I don't know to write a budget. Well, look how many people you know, how many accountants, how many actuaries, how many people do management at the university, your children. It is not that hard. You can always get the help. And once it's written one time, all you're changing is the figures. You're not, basically. So it's a one-time thing. So I recommend to everybody the principle of budgeting. It is crucial to any form of financial planning that you're going to do. If you don't have a budget, you're not planning. You don't have no financial plan. Okay, I know I don't have much time. So I move now into assessing institutions. If you're going to give your money, and this has been alluded to and spoken about already, but if you're going to give your money to an institution, you need to know certain things about the institution. So you need to know to assess institutions. The first thing I look at is who owns the institution. Who are the owners? That's number one. Number two, is there a dominant shareholder? Who is he or she? Because there's a thing we call in actuarial science the dominance risk. Many times when you see a company goes down, you check it out. One major shareholder who won't take all the decisions, and his decisions are his decisions are. You notice I said his, I didn't say her, right? Because ladies don't behave like that. So basically, I always look out for that. You want to look at compliance with the laws. If people, let's say you're supervised by the FSC, whether it's pensions or securities or whatever, have you sent in your returns? Are you doing them on time? Right? Are you in good grace with the FSC? What about the Companies Act? Are you in good grace there? Have you sent in your returns? Are you in any court with people suing you for this and that? All of those things you have to look at when you're talking about a company. What about audited accounts? Are they out? Are they up to date? Are there any problems there? What about information flow? Is this a company given to giving information? I remember there was a great company called Cash Plus. The only thing you could get from it is no information until you hear that it crashed, right? When you see those things, those are red flags. When you cannot get proper information and on a timely basis, you are playing with your money. And after you work so hard, you should not be doing that. I like to look at the capital base of a company. I like to look at the solvency position of a company. I like to look at the history of profits of a company. I like to look at the age of the institution. The fact is, all of these things, I like to look at the reputation of the institution in the marketplace. Things like that you have to look at, because that is what is telling you whether you're dealing with a good institution or a bad institution. And I don't think after I work so hard for the little money that I have, I would want to hand it over to a bad institution. I am not doing it. And I heard this said before, and I'm saying it again, because I have it written down beside me. Your friends, other professionals, institutions, ask questions. Do not just say, boy, I'm just giving them my money. Ask questions. There are many people who can help you with answers. So don't forget to do that. So that is my quick thing about how you assess institutions. Now, how do you assess the instruments, the investment instruments? I'm going to give you a few tips on that now. The first thing you want to look at is guarantees. Does this instrument have guaranteed income or not? Does this instrument have guaranteed capital or not? Very important, those two, right? And don't get me wrong, I'm not saying if it doesn't have guarantees, no good, You're going to see quite the contrary, right? But in investments, you always need a mix of all sort of assets, right? But you still have to be able to answer these questions about each instrument. What about the ability to cope with inflation? Does this instrument react positively with inflation, or does it lose its value because of inflation? Very important. The greatest thief that was ever born is inflation. That it eats out your value without you knowing it. So you need to look at that. On the instrument, historical yields. What sort of yields does this instrument give? What has it been doing over the years? This kind of instrument, not a particular one, but the set to which it belongs. What about the tax position of the instrument? Is it a tax-free instrument? Is it taxable? Is the income taxable? Or is it tax-free? Very important, because that could make a massive difference in the yields that you actually get, right? What about the amount of money that you need to make the investment, to buy the instrument? For example, suppose it's a house, and let's say the house costs 10 million, just for argument's sake, and they say, well, you need to find 20%. It means you must find $2 million to make that investment. Can you afford it? Do you have $2 million? But suppose it's a share. The mind might say the share is for $3. Maybe you can afford that. Therefore, the amount of money which is required to make the investment is really critical. Critical. What about the expertise required to manage the instrument? Do you have it? Do you know somebody who have it? Can you hire somebody to do it? Those things are important. What about the running expenses of the investment? No. Some investments, you have upfront fees, you have in-fund fees, and you have back-end fees, and you have termination fees. All of these things affect the yield on your investment. So you have to find out right up front all of these fees that you will be charged for before you make these investments. Those things are very important. What about the currency? Now, if you are investing, you'll be looking at, we are in Jamaica, and we are Jamaicans, and we are very nationalistic. So most of your investments will be Jamaican dollars. But that does not mean you should not diversify by currency. So you want to say, okay, these are in Jamaican dollars, these are in US dollars, or they are indexed to US dollars, and you have other currencies too, right? But those things are important. What about the term of the instrument? You have short term, medium term, long term. So all of these things are important. You have to know it. You can't just say, I'm buying this. You have to, all of these things I'm saying, you have to go through and make sure each instrument, you check it out so you know exactly what you're investing in. What about liquidity considerations? Let's face it. Let's say you buy a house and something happens and you need some money tomorrow morning. You certainly cannot sell your house. So if marketability and liquidity are very important to you, then maybe the best investment right now is not a house, if you understand my meaning. So this is what I'm saying. You need to have a list of all of these things. And every time you're going to invest, you subject that instrument to these questions and considerations. And you might be surprised that you might surprise yourself and do the right thing. But if you don't do this kind of questioning, you more than likely might do the wrong thing. And the last one I would say under that, because I know I'm running out of time, I'm a long-winded man, the sector of the economy in which the instrument falls. That is always important because not all sectors perform alike, right? And not all sectors perform the same way at the same time. So I think that is also an area that you should look at when you are assessing your instruments. Now, I'm doing it as fast as I can. I'm at number 5, some investment instruments. Well, equities, that is shares. You can either buy them direct or you can buy them through a unit trust. Property, and of course, remember you can have Jamaican dollar, US dollar, or other dollar. Don't forget that, the currency is very important. Property, you can either go direct or you can go through a unit trust. Bonds, and this might be government bonds or private sector bonds, doesn't matter. You can either go direct or you can go through a unit trust, right? And of course, the whole dollar, the whole currency thing is still there. So those, I mean, you have all kind of things, mortgages, leases, all kind of things, but I just wanted to say the more popular ones here because I know I don't have enough time. But I come back now to pension plan as the last one. I will never give up on this thought that for the average man, the base of his planning for retirement is his pension plan. And he should be maximizing his contributions to a pension plan before he ever even think about something else which he wants in retirement. The amount of incentives that the government gives to join a pension plan, the security of the funds afforded by the FSC and TAJ, the FSC by far primarily, but you can't leave out the THA because they do a good function there too, right? Make sure you keep things on par, right? I have to say, pension come first. Maximize everything. If the government say can go up to 20%, go up to 20%, right? Before you start thinking about other things. And when I say other things, I mean for retirement. I know you can invest for before retirement, but I'm talking about for retirement here. Make sure you maximize everything you put in a pension plan. It's very important. And make sure you select the appropriate investment sub-funds. In other words, for example, if we're talking about the ERS here, right? And as we mentioned before, you have sub-pools. I heard the term used. I'll normally say sub-funds, but that's cool. Same thing, right? You need to make sure that when you look at your mix, it is appropriate to your risk profile. And I beg people, and I do beg people, and I want to say this before I close. Equities. A lot of people like to say they carry risk. Well, that is true. But let me tell you, bonds, in my view, carry more risk than blue chip equities. And if you look at the rates of returns over the last 20, 25 years in Jamaica on equities, right? Good equities. And if you measure the real return in terms of inflation, and then you look at any fixed income instrument, it's cheese to chalk. And I'm saying this because a lot of people just choose fixed income things because they thought there is no risk. Fixed income have more risk than equities as far as I'm concerned, because inflation is the biggest thief that has ever been produced. And fixed income cannot protect you against inflation. So that's my last pleading argument that I make to everybody listening to me. Don't dismiss equities and property as risky and leave it at that. They do things that fixed income can never do. So you need a balanced portfolio which consists of everything. And I hereby close in that I know I might have overstayed my welcome.
Thank you so much, Elmo. We could feel the passion. We could feel that you genuinely care about the pension industry. If I wasn't enrolled in a pension plan, tomorrow I will be asking those questions that you advise us to do. The first thing that you said that we should do is to have a plan.
Indeed.
Is to have a plan. And then the second thing you mentioned, we need to budget, because without budgeting, we're not going to achieve that plan. And thirdly, you also mentioned about determining whether or not a company is good or bad. Any company that we're going to be investing in or with, we have to try and determine how long the company has been around. For example, Victor Mutual has been around, the group has been around for over 141 years. You have to find out about the kind of fees that the company charge, whether low or no fees. I'm not calling any name, but these are some important questions, because you also made mention, Elmo, that when you budget properly and you get a bonus, and how you're going to get the bonus, it depends on whether or not the fees are low or whether or not you're going to be charged for everything. So it's very important, very, very important, listeners, in order to find that money so that you can determine whether or not you want 75% of your final salary or you want 100%. It is critical for you to determine which organization you're going to be partnering with. Very, very important. And Elmo also made mention about you have to determine the kind of investment. And the good thing you have to look at when you're trying to determine the kind of investment, it must align with your investment objectives, whether or not you're a conservative person or whether or not you want to take risk. And that is why you need a very, very good retirement planning partner who will sit with you, whether big or small, and they will sit and provide and give you that time of the day to provide that financial guidance. So first, I want to really acknowledge the questions that we are getting. We are getting a lot of questions, ton load of questions. It makes me so excited to show that persons are really, really interested about their retirement. And I want to acknowledge the questions, and I want to keep them coming. Keep those questions coming, because we're going to have a question and answer section after all the presentations. So keep the questions coming. And if you did not register and you're accessing this seminar through our YouTube, I'm going to encourage you to email your questions to us at pensionsinfo@myvmgroup.com. Very important for us to get your questions because we want to guide you along this path. So thank you again, Elmo. I felt the passion, and I hope, and I know persons who are on this seminar, this webinar, also feeling the passion. So if you're joining us for the first time, I want to welcome you again to our 2020 retirement seminar being held by VM Pensions Management Limited in association with our partner, the PSOJ. I'm Conroy Rose, your CEO of VM Pension, and I'm going to be your loyal partner in guiding you to your retirement plan. Now, please allow me to introduce the next speaker. The next speaker is our very own Julian Mazuka, who joined the Victor Mutual family in 2013 when Prime Asset Management was acquired by Victoria Mutual Building Society. Julian Mazuka has over 2 decades of experience. I mean, she looks very young, but she really has over 2 decades of experience in pension industry, starting at Life of Jamaica, where she quickly moved up the ranks to becoming the manager of pensions department. She then spent a decade providing top-notch management services to a family-owned business, helping companies surpassing their targets to achieve annual market growth. Julian Mazuka is the pension administration manager at VM Pensions Management and is an active member of the Anglican Church, serving in areas of education and fundraising. Here to speak to you on the topic of approved retirement scheme. Explain. Here is Julian Mazuka.
Evening, everyone. Thank you so much, Conroy. Appreciate your words there. Thank you so much. So we've heard a lot today. We've heard this afternoon already about the low coverage of persons who are actually participating in a formal pension arrangement. Where do you lie? Where do you fall? Are you in the covered few? Have you taken the steps yet to make sure that you have some security in your retirement years? Just take a minute to look at the what will replace your salary when you get to old age. We know we have NIS. That's not going to give you a very large income because it's a very small amount that's deducted each month from your salary. We have individual savings. All of us will need to be making sure that we're putting aside savings as well. But that's not really the most efficient way of saving for your retirement. Really, the most efficient way of saving is through a retirement arrangement. It's the most tax efficient way of saving. It'll replace a percentage of your salary when you actually go off on retirement, and the pension can't run out. It'll be there, it'll be paid to you for as long as you are alive. You can take some other options. You can think about children as your retirement. You can think about lotto, but these are chances that you're taking. It really takes planning to prepare for your retirement. Why should you think about a retirement scheme? Because in old age, you're not necessarily, and you don't really want to be getting up 9 to 5 every day and going into the office, and you want an income that is a steady flow coming into you to take care of your expenses. Also, in the event of disability, if you're unable to continue working, you know you can draw down on your retirement scheme. And of course, in the event of death, your beneficiaries will be paid out the total amount that you have put aside. The money is always yours to come back to you or to your beneficiaries in one way, shape, or form. Who should join a retirement scheme? So persons who are self-employed, you run your own business, you're a professional, you're in a company, or you're in a company where they don't offer a pension arrangement, or your employment terms don't allow you to participate in the company's pension plan, then you need to take the steps to sign up, to take those steps to sign up for your own pension personal account. a personal retirement account or a retirement scheme, it actually reduces the amount of taxes that you pay. It allows you to defer or even avoid the taxes that you owe, even on the earnings that you accrue each period on the investments that you make. So you're benefiting both from the monies that you put in and also from the earnings that you're getting. And you're earning on top of earning. It's a fabulous thing called compounding. It's the effect of that you're not getting in a regular savings account. This is what you get from a retirement scheme. And as your salary grows, your contributions will grow. As your contribution grows, your balance will grow and will benefit you when you get there from that compounding effect and from the tax deferred saving. The retirement scheme allows flexibility for you to make contributions. So this month you're earning, you can make your contributions as a percentage of what you earn. Next month, perhaps because you're a contract employee, let's say, and you don't have a steady income every month, maybe you don't make a contribution the next month. The following month, you get a bonus. You ensure that you contribute again to catch up, because you are allowed to contribute up to 20% of your total earnings towards a retirement arrangement. You can usually, in most arrangements that are out there, you can choose the asset mix. And you heard St. Elmo talk about choosing a mix that is suitable to your appetite. Where are you in life? Are you closer to retirement? Are you a young person just starting out? You're taking more risk? What is your appetite? You make that decision. You have flexible portfolio options to select from. And you have the benefit of the professional investment managers making these investments on your behalf. But you can make changes as you go along. Most arrangements should allow you to be able to change what risk you're taking on. So you may start off with something more risky, and as you're getting closer to retirement, you look at stabilizing that a little bit and finding something a little bit more a more steady income coming. It supplements your retirement nest egg, and it is one of the most flexible retirement savings arrangements that you can get involved in. So let's look at the tax benefit quickly. Let's say you're in a pension plan. That $100 that you're saving, it's going directly as $100 into your savings. Let's say you earn 10% on your $100. At the end of the day, you're in a net position of $110. Your $100, it has gained 10%, you end up at $110. If it is that you're doing this thing on your own, you're trying to put the money into a savings account, upfront before you can do anything, 25% comes out of that $100. So you're in a net position to go into your savings account of $75. 25% has gone to income tax. You would have to be earning 46% interest in order to come back to the same net position of $110 that you have if you are putting your money directly into a pension or retirement savings account. And if we take it a little further, which is the normal situation, you're trying to put $100 into a bank account, into a savings account, that $100, we said 25% comes off right away, and your interest, you would have to be earning over 61% on that money, on that $75 that you now have in your bank account, in order to come back to your same net position of $110. That in your pension arrangement, in your retirement scheme, your $100 in your account as $100, your earnings, interest earnings, $10 on that at 10%, you would have to be earning over $61% if you're trying to do this thing on your own. When is the benefit paid in a retirement scheme? You have the ability to port. If it is that you want to transfer from one retirement scheme manager to another, you are able to transfer your benefit from one to the other. Or you move into a company that has a superannuation fund and you're now eligible to participate, then you can transfer your benefit that you have in the retirement scheme in this manner. In the event of death, then your total members account, all that you have put in, plus all the investment returns that you have earned, are paid out to your named beneficiaries. And of course, in the event of retirement, once you determine that you're ready to go off on retirement, whether that is early, normal, late, or ill health, then you're moving into your retirement. Your normal retirement date would be as stated in your plan document. And as Cornelia mentioned earlier, your information folder would provide you with this information in terms of what ages, what is your normal retirement age. Usually early retirement is at least 10 years prior to that. And late retirement, up to another 5 years after that, usually you can stay in retirement. Ill health retirement is not an event that you plan for. Ill health it happens, and at the onset, you go off. You can apply for retirement. As long as you're permanently unable to continue working, whether because of a physical incapacity or a mental incapacity, you can proceed on ill health retirement. It doesn't matter how old you are, as long as there is a permanent disability, then you are able to go off on ill health retirement. Let's assume that you're earning $1.5 million. Let's keep the numbers simple annually, and you want to earn $1.2 million as your retirement benefit. You need approximately, as a male, you would need approximately $12 million. And as a female, you will need approximately just over $13 million in your members account as your total amount in your account to be able to go off on retirement and earn that $1.2 million annually. So the annuity provider would take your pot of money and they would convert that into a pension at the $1.2 million paid every month for as long as you are alive. That money is paid out to you. So what you really want to look at is what is the expected salary that you want to have just before you go off on retirement as a ratio of the protected pension that you have saved. That is what is known as your net replacement ratio. This is key. It's well and good that we talk about 1.2 million or we talk about $12 million annually. But what is very important is that replacement ratio. How much of your income is being replaced at retirement? You heard St. Elmo again speak about replacing 75% of your income. You want your net replacement ratio to be at least 75% of your income. So if we look back at the example that we spoke about before, your pre-retirement salary, we said was 1.5 million. Your expected pension is 1.2 million. In this example, 1.2 million divided by 1.5 million, your net replacement ratio is 80%. You are on track. This is how you need to track your earnings. Where you find that you are below the 75%, you need to look at additional investments in order to top up, because you want to make sure that you are earning as much as you can when you are in retirement. And we spoke about as well, you heard already, the need to engage with a company that is reputable, that is registered. So there are protections out there for you. The retirement scheme must be approved. It must be registered with the FSC. It must be approved and registered with the Tax Authority of Jamaica. Your investment manager, the retirement scheme itself, must also be tax compliant. Your investment manager and the proposed team that is going to be investing your money must have the required permits and licenses and certifications under the laws of Jamaica in order to perform these services. The retirement scheme must comply with the law. So all the reporting requirements that Cornelia spoke about before, your retirement scheme must comply. It must have a statement of investment policies and principles that are guided by the regulations of the land. Your administrator, your salesperson must be registered. They must also have the necessary qualifications to provide the advice in terms of how your money is invested. The plans, these schemes are also monitored by external auditors. So an audit must be conducted each year. An actuarial valuation People like St. Elmo White will oversee these plans. They will review and ensure that the plans are able to meet its liabilities, that they're able to pay out the benefits that they promise that they're going to pay out. So how do you get started? It's as seamless and as simple as completing an application form. You provide some supporting information, so things like your proof of income, your valid ID, that sort of information is provided to the provider that you engage with. You also get a tax compliance certificate, exemption certificate from Tax Authority of Jamaica. This will ensure that you can deduct contributions before tax, before any other call on your salary. Your pension contributions, your retirement scheme contributions can be deducted. And you heard St. Elmo say it, form a good habit and consistently make your monthly contributions. Pay yourself first. Ensure that you keep in touch, you log on, make sure that you stay connected and you keep track of what's going on with your investments, with what's happening with your contributions. Review your information. You heard the reports that are coming out to you, that are available to you. Review this information and make sure that you are keeping track, you're on track to meet the kind of lifestyle that you want to have when you get to that point when you are actually now going off on retirement. So are you enrolled? Have you taken those steps? Are you maximizing the tax breaks that you can get from being a part of one of these arrangements? Are you making the maximum allowable 20%? Your financial well-being is up to you. The question, in the words of George Foreman, the question isn't at what age I want to retire, it's at what income. Thank you. Mr. Rose, back to you.
And thank you, Julianne. And Julianne said, it is up to you. Your retirement, the quality of life after retirement is really up to you. You have to decide at this point in time and take it into your hands. What is it that you're going to do? Sir, St. Elmo said, start now. So if you're not enrolled in a retirement scheme, you need to start now. And Julianne mentioned earlier that the ARS, it is very flexible. It doesn't require any big money to start, because we generally have this idea that in order to start, we need to be contributing a big money, as what most Jamaicans would say. You need to start small. Just imagine from when you left high school and you start working. For those of you who are not contributing, you start contributing as low as $1,000 per month. Just imagine what your pension, accumulated pension, would look like at this point in time. So the most important thing, and I really want to urge you, is to start now. Start small. As your situation improves, as your salary increases, then you can increase the amount in keeping with your plan. Do you want 75% of your final salary? Do you want 100%? So viewers, I'm encouraging you. Julianne Mazuka has provided you with the information that enrollment is easy. It is very flexible. You set the amount that you want to be contributing per month. You determine that. And as the situation improves. So thank you so much. The presentations were very enlightening, right? Cornelia explained about the regulations. Cornelia explained how regulated the industry is and how safe the industry is, right? And then the second presenter, St. Elmo, who was very, very passionate about helping his Jamaicans in securing a pension. He mentioned about planning. He mentioned about budgeting. He mentioned about finding the right partner, the secure partner to really provide retirement planning. And then Julianne Mazuka came with the icing on the cake by telling you how to start, how to get going. And now, we are now at the end of this session, and we are now going to move directly into the question and answer segment. So as I said before earlier, we got some very, 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 very good questions. So I'm now going to move in. The first question that we got from Romaine Stewart. And this question I'm going to ask, I'll take this question. The question is, any advice for public sector workers who wish to augment their pension? That's the first question. And if you are currently actively contributing to a pension plan, you cannot contribute to 2 pension plans at the same time. What I would advise you to do, as St. Elmo mentioned earlier, pension is just one class of asset in your overall investment. So what I would advise you to do is to look at investing in other investment options. Investing in, for example, with our Victory Mutual Wealth, they have different kinds of asset class, maybe bonds and maybe stocks. So you can invest, or probably real estate. So in this case, I would recommend that you speak with one of our financial advisors at Victory Mutual Wealth, and they will provide some alternative options that you can invest that will supplement your pension. The second question came from Peter Gay Saunders, and this question I'm going to ask Julian Mazuka to answer. It says, how much would I need to start a pension fund?
So in order to start, remember that your contribution is coming from your salary. So your contribution has to be a function of your salary. You can make the maximum contribution of up to 20% of your earnings in any one year is what you can contribute towards a retirement arrangement. Right.
So Ms. Mazuka said that you can contribute up to a maximum of 20% and a minimum of $5,000. So when persons believe that they need to contribute in $10,000, $5,000, that's small, that's $5,000 per annum. And that is why I'm encouraging you to start right now. Don't think about because I do not have a disposable income. Budget and plan and get starting. The next question, in what way does your gender affect your pension benefits? I'm going to ask Julian Mazuka to take this question.
So at the end of the day, if you recall in my presentation, I was speaking about a female would need 13.2 million if they wanted a pension of 1.2 million per annum, and a male would need 12 million, approximately 12 million, to earn that same 1.2 million. And the difference is simply because we live longer. Females tend to live longer. The statistics show that females live longer than men, and therefore the money has to last longer. So this is the difference. The males tend to not live as long, and therefore the pension, the pot of money is a little less required for the same amount of the dollar value to be paid each month.
Thank you, Julian. And the next question goes to Cornelia. And this question comes from Elmar Henry. Can you be a member of 2 retirement schemes or superannuation fund, or a member of a scheme or a superannuation fund? This question goes to Cornelia.
All right, so currently you can't. Currently what is required is that you will contribute to only one private pension arrangement at a time. But the FSC, having seen this and realized the limitations associated with it, is actually taking steps to amend the legislation to change this so that you can be a part of as many pension fund arrangements as would suit your needs. So as phase 2 is rolled out, you will find you can be a part of a superannuation fund and an ARS or other ARSs, or you can be a part of multiple ARS. And what this will do is engender competition and allow persons to be incentivized. Investment managers will be incentivized to perform to ensure they compete for your funds.
Thank you, Cornelia. And the next question comes from Andrea Foster. Can you please verify if you are in an ARS? Can you purchase an annuity before this government normal retirement age? Early retirement? If so, at what age? I'm going to ask Julian to take this one as well.
So you'll be able to purchase an annuity based on the retirement age stated in the based on the retirement age that is stated in the documents of the scheme that you are participating in. So again, your information folder will highlight this information, and it will tell you what your normal retirement age is or what your early retirement age is. That point, you can purchase an annuity from one of the insurance providers in order to start getting your pension. So for example, in our retirement scheme, normal retirement age would be age 65. At that point, that is when the person would be able to purchase that annuity.
And the next two questions, I'm going to ask St. Elmo to take the next two questions. And the first one, what is the difference between a pension scheme and a superannuation plan? And then the following question for St. Elmo, what would you suggest could be a good fund mix for a 30 to 35-year-old, regardless of the risk appetite? So St. Elmo, those two questions are yours.
Okay. Well, am I being heard?
Elmo, go ahead.
Okay, good. As far as I know, there's no difference between a pension plan and a superannuation plan. It's just two different names for the same thing. Superannuation, if you listen to the word properly, means above salary. In other words, your pension really is a benefit above your salary. Superannuation. But the same thing, pension, same thing, no difference between those two. The other one, I can't answer it. I must tell the truth. When it comes to investment mix for people, you have to talk to people and get certain basic background information. And then you make a determination of a suitable investment mix. So that one cannot be answered as asked. What I would say to people though, when it comes to personal financial planning, there are books, on personal financial planning, which can help them a lot in how they go about doing it. And I think you can talk to people, yes, but there are also books you could read that give you a very good idea of how to go about. Books on personal financial planning, written special for the occasion, that will help you how to go about doing these things and how to choose your mix and all that. Looking at your risk profile and so on, asking you questions and showing you how to determine a mix. So that's what I would say about that one.
Elmo said, this is what retirement planning and financial planning is what the VM Group provides. So that is why I would encourage you to come in and talk with one of our advisors. We will sit with you. We will look at your situation. We will assess your situation. And we will recommend what is best for you. And this is what the group does. The retirement planning and financial advice. So come in and sit with one of our representatives or call us. The next question comes from Sophia Johnson. I'm self-employed. How do I go about it? How do I go about enrolling in a pension plan? It's very simple. Judy and Mazuka made mention about it earlier. There are some KYC requirements. The first, you need to have an ID. You need to have a TRN in terms of 2 references. The good thing is that you can provide 2 telephone references. You don't have to provide physical references. Once you give us the name of 2 persons, whether it's your employer, a JP, a senior police officer, you can just give us a number and we will contact those persons. In addition to that, you also need address verification, and that usually for address verification, you can use a utility bill. If you do not have a utility bill, we can provide you with a form that you can get a justice of the peace to verify your address. If you do not have a utility bill with your address, we can give you a form that you can get a justice of the peace to verify that. And most importantly, is to complete the forms, and we will assist you to complete the forms and make it a simple and seamless process for you. The next question, and this is the final question, it's coming from Dr. Marcia Gordon. Can you join a pension scheme while living abroad? So the question is, I'm going to ask Cornelia to answer this question. Can you join a pension scheme while living abroad?
No, your pension, your ability to contribute in a pension plan is really based on having undertaken a trade that is in Jamaica. So you would have to actually be earning income in Jamaica. Now, what I will say is we have been looking at a number of ways that we want to safely allow persons to contribute to their own financial well-being. And to that end, the Financial Services Commission has launched a project and currently at the investigation stage where we're researching through micro pensions, is there any way that we need to look at certain allowances that would allow persons to contribute more effectively to their retirement? We have a large pool of workers who work in the USA, Canada, other countries, and then return home to Jamaica. You know, these are things that we're currently looking at and exploring to see if there are opportunities for them to contribute to an approved retirement scheme and benefit from it. So there are definitely things that are in play. And what we want to encourage you to do is whatever means necessary once you are qualified to contribute to a pension plan, that you do it.
Yeah. And we are at the end of this wonderful session. And at the beginning of my opening remarks, I asked two questions. The first question was, are you concerned about your life after retirement? And the second, especially now, in unprecedented time. And the second question I asked, are you currently contributing to a pension plan? And then I said, if the answer was to the latter one, no, you're not currently contributing. And if you're concerned, you're at the right place. We have provided some information today that we hope will assist you in making that move in starting now. Not tomorrow, but starting now. And remember, plan, budget, and it doesn't have to be a big money, as what Jamaican would say. Start small. And I want to thank you all for participating in our first virtual retirement seminar. Coming to give the vote of thanks is our own business development officer, Monique Foster. And I now invite Monique to give the vote of thanks.
Thank you, Conroy. So this is where we'll end our retirement seminar 2020. And on behalf of the Victoria Mutual Pensions Management Team, PSOJ, as well as our viewers online, I'd like to thank our guest presenters, Mrs. Cornelia Harper Peck and Mr. St. Elmo White, as well as our very own Miss Judianne Marzuko. We are sincerely grateful to you for sharing your words of expertise. Also, on behalf of the Victoria Mutual Pensions Management Team, as well as PSOJ, I'd like to thank you, our viewers online, for joining us today. And if you are just joining in, well, fret not. You can watch the entire seminar on our YouTube and Facebook platforms. And remember, the more years you have to contribute is the greater your retirement income can be. So start today. Better yet, give us a call tomorrow at 876-562-7183. That's 876-562-7183. Or send us an email at pensions.info@myvmgroup.com. Looking forward to hearing from you tomorrow. Take care.
Bye, everyone. Have a wonderful night.